Hi everyone, so welcome for today's session. Now today's topic I want us to cover capital budgeting, and capital budgeting is one of the major topics in financial management. Actually this topic will lay a backbone of all the other remaining topics. Now the topic is capital budgeting, also known as the investing decision, and this involves capital budgeting decision. This involves commitment of funds in long-term projects which will generate the benefits in future. So therefore it's all about evaluation of long-term projects which are expected to yield the benefit in the future. So now with that, as per the definition, therefore, what are some of the characteristics of the capital budgeting project? When we talk about the capital budgeting project, we are talking about the long-term projects. And these are some of the characteristics of capital budgeting. Number one, they are long-term projects. And since they are long-term projects, number two, they require huge initial capital investment. Number three, the benefits are expected to be realized in the future. Therefore, if they are long-term projects, now before completion or after completion, that's when most of the projects they're expected to generate the cash flows. So that's why you're saying that benefits are expected to be realized in the future. Then number four is that they are irreversible projects. Irreversible project, that means that we're saying that they involve huge capital outlay. So how are those projects irreversible? That means once undertaken, it's difficult to abandon that project. That's what we mean by irreversible project. Once undertaken, it's difficult to abandon that project. Then number five is that they are highly risky project. What makes this project to be risky? Number one, you say that they are long-term projects. Then the benefits are expected to be realized in the future. If the benefits are expected to be realized in the future, you know we don't have control about the future. So there is that aspect of uncertainty. So that's what makes this project to be highly risky. And we have various types of capital budgeting projects. Number one, we have what we call the mutually exclusive project. Now what do we mean by mutually exclusive project? Now mutually exclusive project, they are what we call substitute project. They are projects which serve the same purpose. That means if one project is undertaken, automatically the other project will be rejected. So because they are serving the same purpose. It's like, for example, having two blue pens, and then you just need one pen, right? Do you take all of them or just take one? Because they are serving the same purpose. Both of them, they are blue. Now that's what you call mutually exclusive project. And you're saying that they are projects which are substitute. That means they are projects serving the same purpose. Therefore, when one project is undertaken, automatically the other one will be rejected. That's what we call the mutually exclusive project. Number two, we have independent project. Independent project, they are projects which does not interfere with each other. So therefore, if one is undertaken, also the other one can be undertaken without influencing each other. Those are what we call independent project. Then we have what we call dependent project. And dependent project are also known as the complementary project. A dependent project, they are projects which depends on other project. That means if one project is undertaken, the other one automatically will have to be undertaken. If, for example, you have project A, project B, project C. In that, project C depends on project A. I mean project C depends on project B. And project B depends on project A. That means you cannot undertake project C if you have not undertaken project B. And you cannot undertake project B if you have not yet undertaken project A. Those are what we call dependent projects. They are projects which depend on each other. That means if one project is undertaken, automatically even the other project will have to be undertaken. Then we have divisible project. Divisible. What do we mean by divisible project? Now divisible project, these are the projects which can start generating inflow even before they are fully completed. Let me repeat again. Divisible project, they are projects which can generate inflows even before they are fully completed. Now, for example, let's take a scenario of rental houses. Rental houses, you can build like maybe 3 floors. Then you get some tenants. Then after some period, you decide to add other floors. You see now that's what we call a divisible project. This project has been can start generating inflow even before the whole project has been fully been completed. Or also CPA, this course we are taking. Yeah, you know CPA is also a project. I also tell my students that education is an investment. Why? They are long-term project. You don't get certificate in 2 weeks. They require huge initial capital. Now, apart from the school fees you pay, you also invest your time. You also invest your fare, other resources. You know, for the student, what they usually factor in, they only factor in, I paid a school fees maybe of 20,000, 30,000. What about the transport you use? What about the time you invest? So that's part of the capital. Yeah, capital is not about the financial requirement. It's all about the resources and also the time. Then the benefits are expected to be realized in the future. Why do you have to invest in education now? Because in the future you expect to get a job. So therefore, the benefits are expected to be realized in the future. You don't earn when you are studying. The only person who earns is the teacher here. Then number 4, they are irreversible projects. Though in this case most of the students tend to give up, mostly the CPA. Then they are highly risky projects. There is no guarantee that you have to pass. Sometimes you can struggle with the CPA. So therefore, CPA or education, we are saying that it's an investment. Now CPA, a student with CPA part 1 or the foundation level, or student with CPA part 2 or intermediate level, they are eligible to work as an accountant. And most of the evening student, or most of the student, or most of the accountant or the account assistants, most of them have not completed up to the advanced level section 6, but they are working in accounting department. You see, why are they working in account department? Because of that certificate they have either for part 1 or the foundation, or part 2, that's for the intermediate level. But you see now, that project has already now started generating some income. That's what we call a divisible project. A project which can generate inflow even before they are fully completed. Then number 5, we have indivisible project. Indivisible project, they are projects which cannot generate income until or unless they are fully completed. You have to complete this project. For example, we can say, what about law or medicine? These are other courses. They are also projects. Number 1, you cannot practice as a lawyer if you are not a member of LSK. And for you to be a member of LSK, you have completed that degree. Yeah. The same with medicine. Even for the intern, they just follow. That's not an employment. They just follow what other doctors are doing until you get the practicing certificate. So therefore, that's what we call an indivisible project. A project that cannot generate inflow unless they are fully completed. Then we have replacement project, and then we have acquisition project. Those are various type of capital budgeting project. Now, how do we evaluate those projects? Yeah, because you as a financial manager, this is the work of the financial manager. For the financial manager, sometimes they usually do assess the viability of a project. And that's what we call now the project evaluation techniques. And project evaluation techniques, this involves cost-benefit analysis in order to determine whether the projects are viable. Viable, that means that will the project be profitable? And in this case, there are 2 techniques which are used. One is known as the non-discounting techniques or traditional techniques. And then number 2, we have discounting techniques. So what's the difference between the 2? Non-discounting techniques, they are techniques which does not take into account the time value of money. There's no discounting of cash flow. Make sure before you go through this topic, you have gone through the other topic of time value of money. That's when you are explaining what we mean by the time value of money. Yeah. Non-discounting, we are saying that it does not take into account the time value of money. But for discounting techniques, there are techniques which take the time value of money. And when evaluating this project, we'll be using discounting techniques. But first of all, let's start with the non-discounting techniques. Saying that there are techniques which do not take into account the time value of money. And they include, number 1, we have the payback period. Number 2, we have the accounting rate of return. Let's start with the payback period. Payback period. What do we mean by payback period? Now, payback period is the length of time taken to recover your initial capital. How long does it take? For example, if you invest 1 million in a project, how long will it take for you to recover back that 1 million? That's what we call the payback period. And usually pay that. For payback period, the shorter the payback period, the better and less risky the project is. The shorter the payback period, the better and less risky the project is, and vice versa. And how do you determine the payback period? So I want us to do an illustration. In our notes, we have an illustration there. So let's go to our notes. And the payback period, there is illustration 1 I have provided there. And make sure, as you watch these videos, make sure you have the past papers with you, and then you also have the notes with you. Yeah, don't just use the videos alone. Use the video as well as you have the notes. Now, illustration 1 under payback period. Illustration 1 on payback period. Consider a 5-year project whose initial investment is 100,000 and the project is expected to generate the following cash flows. So the capital is 100,000. So you're given year 1 to year 5, then you're given the cash flows required. Calculate the payback period of the project. Calculate the payback period. So here you have the period. So this is illustration 1. We have period, the project is for 5 years, year 1, year 2, year 3, year 4, year 5. Then you are given the expected cash flows. Year 1, we expect to generate 35. Year 2, we have is 30. We have 35. We have 25. We have 20. That's what we are given. Then we had invested 100,000. So we want to determine the payback period. To get the payback period, you get the accumulated cash flows. You accumulate the cash flow. So the first one is 35,000. 35 plus 30, you get 65,000. 65,000, you add 35, you get 100,000. 100, you add 25, you get 125,000. 125, you add 20, you get 145,000. Then you want to determine the payback period. You had invested 100,000. So, and here we have our 100,000. So that means the payback period will be 3 years. You recover back your initial investment within 3 years. So we also want, let's also do another illustration. Illustration 2. Now, assuming the above cash flows, now assuming the same cash flow, but now with the initial capital of 120. But now assuming this case, you see in this question, the initial investment was 100,000. Now, assuming the cash flows now was 120,000. How do we get the payback period? Assuming it's 120. So, do I have to copy this? Okay, let me just copy it again. Cash flows. So here we have 35. We have 30. We also have another 35. 25, 20. 35. 65. 100. 125, 145. So now assuming the initial capital of 120. So 120, that's where 120 is. So that means the payback period will be between year 3 and year 4. So therefore our payback period will be 3 years and some months. So how do you determine that specific month? To determine the specific months, you will take the initial capital, you raise the ROA limit, you divide by the upper limit minus ROA limit, then you multiply by 12. 12 represents the number of months. So you take the initial capital minus the ROA limit. Now, for example, in this case, now let's look at this. You see the initial capital is in between 100 and 125. 100 becomes our ROA limit, 125 becomes our upper limit. So now let's evaluate that. So the payback period, it's 3 years. Now we want to determine those specific months. You will take the initial capital, which is 120,000, you minus ROA limit. The ROA limit is 100,000. Then you divide by, You take the upper limit in this case is 125, minus the lower limit. The lower limit is 100,000. Then you multiply by 12. In that case, you get it's 3 years. And that's 20 over 25. Then you multiply by 12. And you get 10 months. If the capital is 120,000, that means the payback period will be 3 years and 10 months. Good. So in your notes, I have provided the advantages and disadvantages of using the payback period. Then another method under the non-discounting techniques we have is the accounting rate of return. Yeah, ARR. And what do we mean by the accounting rate of return? Now, this method uses the accounting profit, not the cash flows. It uses the accounting profit to evaluate the project, and is computed as follows. It's computed as follows. So how do we compute the accounting rate of return? They're saying that accounting rate of return uses the accounting profit. So you take the average accounting profit, that's the earnings after tax. Then you divide by the average investment. Average investment, then you multiply by 100%. And how do we get the average investment? To determine the average investment, you take the initial investment, that's the capital. Then you add the salvage or the scrapped value. Now the salvage value is what you realize the scrap value at the end of the economic life, and then you divide by 2. So now let's do that illustration in our notes. Consider a 4-year project whose initial investment is 150,000 with a salvage value of 50,000. The project is expected to generate the following accounting profit. So you're given year 1 to year 4, and then you're given the earnings after tax. So now let's determine that. You determine the accounting rate of return. So to get the accounting rate of return, first of all, you need to get the average accounting profit, average earnings after tax. So you're given the cash flow for the 4 years. So we have 40,000, year 2, 30,000, year 3, 20,000, year 4, 10,000. Then you get the average by dividing by 4, and you get an amount of 25,000. Also, you need to determine the average investment. For the average investment, you say that you take the initial investment, of which you invested 150,000. Then you add the salvage value, and you are given a salvage value an amount of 50, that's 200. Then you divide by 2 to get an amount of 100,000. So now that with that, now let's get the accounting rate of return. Accounting rate of return, average profit is 25,000, average investment is 100,000, then you multiply by 100%. That means the accounting rate of return will be 25%.